I'm just going to do a short overview of the topic of impact investing, a little bit about what it is and how it's particularly applicable to real estate, and then we can delve into some of those issues in a lot more detail in our panel discussion. So just to start off, with a really quick introduction to who Nuveen Real Estate is. We are a global real estate asset manager, one of the top 5 in the world, with just over $130 billion worth of assets under management spread across the US, Europe and Asia Pacific, and we're based in 25 cities globally. For us, ESG and impact investing is a really significant part of our business. So our 3 key pillars are set out here. So it's about income, alternatives, of which real estate is our largest, and then leadership in responsible investing. So the concept of impact investing is very much part of how we invest and what we do. So I just want to start off by explaining a little bit about how impact investing is different to the standard integration of ESG. We've got on the left of this slide here mainstream investment. So I think what we have seen over the last decade or so is ESG integration really coming into the mainstream. So you still have some investments which are only financial and aren't looking at ESG at all, but that's increasingly rare. And now it's quite standard for most investments to incorporate some level of ESG screening, ESG risk, integration of ESG opportunities. So that's what we see on the right hand side here. So the concept of looking at ESG issues with every investment. So for real estate, that would typically be looking at what the energy efficiency of a building is when it's being acquired, looking to improve its performance, looking at things such as waste, looking at its role in the community, and that's fairly mainstream in most real estate investment now. How that differs when we move into impact investment is that environmental or social objectives are put on the same level of importance as those financial return criteria. So whereas with ESG integration, whilst ESG might be quite a significant part of a strategy, and you might have targets to reduce carbon emissions or improve the energy efficiency of buildings, those objectives are always subordinate to the overall return criteria, and it's always about the main objective of that investment will be to deliver a certain return, and ESG might be a part of that, but it won't be on equal footing. With impact investing, there will be clear objectives that are made transparent to investors, and all investments will have to meet both those return criteria and those environmental or social criteria. So, for example, if it's a investment around affordable housing, and there is a criteria that a certain proportion of units within investments must be affordable, then no investment would be able to progress if it didn't meet those affordability criteria, and that's different to the kind of standard ESG integration. Then you move over more to the right and you have philanthropy, which is clearly where the social or environmental objective is the primary driver. So impact is around where putting the environmental and social on an equal footing to the return. And I think this quote from the Global Impact Investing Network is very helpful, which sets out a little bit more about what impact investing is. So they're investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. So just delving into that in a little bit more detail, what are the hallmarks of impact investing? How can we recognise impact investing as different to ESG? And these 3 criteria are the real key, the real hallmarks of what makes an investment an impact investment. So that is intentionality, and that goes back to having those clear objectives around social or environmental issues. So stated clear objectives that are a part of the strategy and have been developed right from the get-go. So a real estate fund that is addressing a specific environmental or social issue, and that is made clear from the start. Then additionality. So that is about ensuring that the positive impact that the investment delivers would not have occurred anyway. So a good example there is just investing in, if we return to our affordable housing example, investing in affordable housing building would not on its own necessarily be impact investing unless you were delivering additional, so by creating new affordable housing or preserving affordable housing which may have been at risk of not being preserved otherwise. So that additionality is important. It's not just about investing in something that would have happened anyway, it's about delivering additional positive impact. And then finally, measurement. So this really underpins both the intentionality and the additionality pieces. You need to set out clearly what are the impacts that you are seeking to address, how those will be delivered, and then how you will prove that you have actually delivered those impacts. So measure those throughout the course of the investment and report on those to investors. So again, if we look at our affordable housing example, you would be monitoring the number of affordable housing units that would be delivered, also be measuring what that level of affordability is. So if you set out what your criteria for affordability is, typically it would be no more than 30% of the income of those in that housing. How are you ensuring, how are you measuring the income level, for example, of the local population? And how are you ensuring that the right people that you want to reach are in that housing? So that measurement piece is really important. There are a couple of additional areas which typically go alongside impact investment. So that is the theory of change and responsible exit. So the theory of change is the kind of overarching methodology which sets out what is the problem that you're trying to solve for, and how does this investment strategy actually address that problem? So it's setting out the whole investment process and how that addresses that societal issue, whether it be environmental or social. And then finally, responsible exit is really important. So in engaging in impact investing, you have to think about what happens to that investment once it's been sold. So again, an affordable housing investment, you're limiting the extent to which that can have an impact if you're selling it on to somebody who's going to turn it into luxury flats, for example. So there does need to be an element of looking at who is going to take that investment on next and what's going to happen to it. So hopefully that gives you an overview of how impact investing is different to ESG integrated investing, and it is a specific style of investing which has unique characteristics. In terms of what are the typical social and environmental issues that are covered, these are really broad, and this just gives a bit of an overview of what some of those could be, but it's by no means meant to be exhaustive. So you can see here the different sustainable development goals at the top, and then at the bottom we've got the different areas that are in the UN PRI, Principles for Responsible Investing, and you can combine those and you come out with these 10 broad themes. 6 around environment and 4 around social, which are relevant to impact investing. As I say, this really isn't intended to be an exhaustive list, and there will be other issues that impact investments can address, but it's probably a good overview of the typical sorts of issues you'd expect to see tackled by impact investment. So, renewable energy, green buildings, energy efficiency, and then on the social side, looking at affordable housing, provision of education, health, etc. So these are the sorts of areas that we typically see being a big feature of impact investments. And I wanted to look a little bit more specifically at real estate and how real estate can be used as an impact investment. I think it's probably fair to say that when we think about ESG issues in real estate, we typically go to the E, we think about environmental, and there's been rightly a lot of focus on the role that real estate can play on that environmental side in terms of reducing its carbon emissions, improving the amounts of renewable energy, and looking at decarbonisation in construction, for example. But real estate can generate a really positive social outcome as well. And I think it's a natural home for the social side of impact investing. So by its nature, an investment in real estate is an investment in a community, and real estate has the potential to generate positive social outcomes, whether that be directly through the provision of socially useful buildings such as affordable housing, education and health facilities, whether that be through the improvement of local areas such as investments in the public realm and social infrastructure, whether that be through supporting occupiers to deliver positive community outcomes by providing, engaging with charitable occupiers, for example, or occupiers with a social purpose, and engaging with communities and delivering a positive community benefits. There's also the indirect benefits that investment in real estate can deliver, and these are more on the economic side. So investing in economically underserved areas or underinvested areas, positive and responsible regeneration, delivering job creation, and looking at those locations in the UK and more broadly that have not had sufficient investment in the past and are in deprived areas. And when we look at the strategies coming out of the government at the moment around building back better and the levelling up agenda, I think it's clear to see that real estate investment can play a key part in delivering that agenda. So real estate certainly has a role to play on delivering social impact. I've already talked a little bit about the role that it has to play on environmental, but we are on the cusp of going through a decades-long transition to the low-carbon economy. All buildings are going to need to be net zero carbon by 2050 at the latest, and I think we can see that in Europe in particular, we might be looking to achieve that goal much more quickly with lots of European-based real estate investors and companies committing to achieving net zero carbon over the next 10 or 20 years. So impact investing also can play a real role in driving that change towards net zero carbon buildings, and really important that real estate embraces that and we achieve that transformation to net zero carbon buildings as quickly as possible. There's also a real opportunity to really blend these different environmental and social issues together. So I think it's probably a mistake to look at the environmental and social as totally separate. Actually, it's helpful to combine them together and think about buildings that can deliver both positive environmental outcomes and also be really rooted in their communities. And I think mixed use buildings have a really significant role to play here. So if we think about buildings that might be combining different types of real estate, such as retail or leisure combined with housing or office, repurposing redundant buildings to really meet community needs and using that repurpose to actually focus on achieving environmental outcomes as well, and then also looking at the public realm and looking at the broader environmental impacts such as investment in biodiversity and parkland, and creating more positive spaces for communities. There's also a real opportunity there to repurpose real estate to meet the needs of those businesses that are going to be growing over the next 10 to 20 years as the economy reshapes to meet the needs of the low carbon economy. So a huge amount of change as we move towards the buildings of tomorrow, and impact investing certainly has a major role to play in that. So I'm just going to finish off by showing you a few examples of some of the sort of tools and frameworks that might typically be used in impact investing. This is what a typical impact management and measurement framework might look like, and as a useful graphic to show what those different elements look like. So setting up for that intentionality piece, the impact strategy and goals, integrating social and environmental objectives into the sourcing and due diligence, and really evidencing that in a very robust way in order to meet those intentionality, additionality and measurability requirements. Incorporating that through portfolio management and with a strong emphasis on measurement and reporting throughout. Responsible exit, and then disclosure and verification. So I think this is probably a fairly typical management cycle that would be recognisable to any investor that incorporates ESG into their strategy, but it's just really about beefing that up and ensuring that we have that those intentionality, additionality and measurement requirements are really integrated in and can be evidenced in terms of how those requirements have been looked at every stage of the investment process. This is an example theory of change. Looking at the typical ways in which real estate can address social and environmental impacts. The inputs that a real estate investor can provide would typically be long-term financing, real estate expertise, and infrastructure and networks across the real estate industry. Real estate investors can acquire buildings in areas of deprivation, provide green upgrades to buildings, improve community infrastructure, and develop local stakeholder partnerships. And those are the key activities that are actually being undertaken by the real estate investor. And that results in a range of different outputs. I've highlighted just a few here, but increased number of net zero carbon buildings, increased access to services by the underserved, and economic benefits such as job creation. The knock-on outcomes of those are improved standards of living, greater take-up of net zero carbon buildings across the UK or other European countries, economic development of areas of deprivation, and potentially improved health and well-being, both from buildings that specifically address that, but also from the improved health and well-being that tends to come alongside economic improvement. And typically an impact strategy would look to tackle specific sustainable development goals. So I've highlighted some obvious ones here, which this type of strategy would address, such as sustainable communities, the mitigation of climate change, and reduced inequalities. But there's a whole range of SDGs that could be tackled. I think a key important factor in impact investing is when we look at origination and deal prioritization, and this is something that comes up a lot when talking to investment teams about the shift towards impact investing. So at the point of origination, there needs to be a process whereby the actual potential impact of an investment is rated or scored alongside the potential investment return that you would expect. And then what you're ideally looking for is to prioritise those investments that deliver both the maximum amount of social or environmental impact and the maximum return, and that's known as the efficient frontier. That's priority one. But then, this is a suggested prioritisation, but it could differ. So we've suggested here that the second priority would be investments that meet a financial hurdle that has been set, but maximise impact. Priority 3 might be those investments that maximise the financial return, but still meet that minimum level of impact. And then your priority 4 buildings investments would be those that just meet both of those hurdles. And you would expect to see some investments being screened out as either being unacceptable from a financial perspective, not delivering the returns that are necessary for the strategy, or unacceptable from an impact perspective. So maybe those buildings that have no feasible way of achieving net zero carbon, or where there are controversial tenants in place, or where buildings are maybe detrimental to local communities rather than positive. And then finally, it's also, this isn't just about selecting investments. This isn't just about choosing a building that's going to be socially useful and deliver environmental improvements. It's about that investment process throughout. So you have the where will we invest, and why are we investing in these locations, but then what are we investing in, what types of buildings, how are they socially useful, how are they delivering the environmental return, what asset management activities are we undertaking to actually deliver the social and environmental impacts and improvements that we want to see, and then finally the validation of that impact. So it's about not looking at the full process and how impact is delivered throughout. Okay, I will stop there and hand back to Richard for our panel discussion.
That's great. Thanks very much. Great, really interesting. So let's just pick up. I'm going to see if I can just get rid of that reverb, which seems to have appeared. It's gone. Thank heavens for that. Good. Let's just start with introductions. For the benefit as well of those who may be watching this on demand, let's just start with also just a brief introduction of yourself, Abby, just again in case people are solely watching the panel. Abby.
Hi, I'm Abigail Dean and I'm Head of Strategic Insights for Nuveen Real Estate. We're a global real estate asset manager.
Super, thanks very much. Michel.
Thank you, Richard. Good morning, everyone. My name is Michel van Oostvoorn. I'm Director of Investments at Hartelt Fund Management. We manage the Apollo Healthcare Property Fund. The fund invests in senior housing and healthcare facilities in the Netherlands. And we currently have a portfolio of approximately 160 million spread over different sectors in the Dutch healthcare market. And the fund provides for institutional investors a combination of a stable financial return and a sustainable impact return.
Great, thank you. Martin.
Thank you, Richard. Hi, my name is Martin Zdravkov. I'm the Head of Impact and Head of Residential and Impact Investment at LaSalle Investment Management. We are a global investment management firm with my responsibilities effectively covering all investments that have a bed in them.
Great, thank you. Nella.
Thank you. Good morning, everyone. I'm Nella Krier, the Head of Sustainability and CSR at BNP Paribas Real Estate Investment Management. We are a European investment manager, investing in around 17 countries and managing 30 billion of assets. And my role is definitely to define and implement a specific ESG strategy for our investors.
Great, thanks very much, Nella. Ron.
I'll put my microphone on. Morning, my name is Ron van Boys. I'm Senior Lecturer at the Amsterdam School of Real Estate since 2012. Both on Master of Real Estate Resources and also on the Executive Education. And beginning of 2020, we founded the Senior Housing and Healthcare Association. And I'm proud to be the chairman of this multi-stakeholder and pan-European platform. And next to these activities, I'm also having my own advisory firm called Multiple Impact, totally focused on alternative real assets and investments.
Great, thanks very much, Ron. Martin, let's just start with you, and I'm going to pick up some of the points that Abby had in the presentation there. Really, lots of great detail. And of course, if you've got questions or comments, do please make them. You can use the Q&A or the chat buttons. I'll be monitoring those. And that's one of the joys of being live, is that we can answer your questions. So if you've got any questions, do please ask them. Martin, just coming to you. I mean, there's been a growing focus throughout the pandemic on ESG more broadly. How do you see this influencing investor demand, particularly for sort of responsible investment and impact strategies?
Yeah, excellent question. Thank you, Richard. And let me just start by saying, Abby, that was a fantastic presentation. Thank you very much for that. I think it's fair to say that ESG and responsible investment has shot up at the forefront of investors' considerations. I've been saying for a while that every investor is an impact investor. It's just some of them don't know what the impact is. And what the difference with the impact investing is, you actually, as Abby very eloquently said, you measure and you manage the impact of your investments. And I think that's really what has heightened the investors' demand during the pandemic, is just realizing how exactly are we contributing to a problem, or are we contributing to a solution? And being able to contribute to a solution without sacrificing risk-adjusted returns is really what has driven the increase in impact investment and ESG strategies.
And from your point of view, Ron, just you know, when we're looking at impact, there's a lot of different meanings for that. So I suppose, how do you quantify that for your business?
Yeah, well, I also totally agree on the keynote of Abigail. I think in general, investors are searching for volume, size, and yield, but I think more and more we see investors are focused on the global trends and also the shifts, because I think, for example, scarcity of resources, health and well-being, but also the aging demographics are very important trends where investors try to align their strategy on. And therefore also real estate investors are more and more focused on investing in senior housing, healthcare real estate, educational facilities, but also, for example, the life sciences. And I think it's indeed, it's going from matching on Paris Proof agreement, but also more and more on the social element. And I think one of the biggest challenges is to measure the impact and also to try to create a value chain between the user, the investor, and also the SDGs where we try to align on. And I think this is also where we have to cooperate more closely in the value chain of real estate.
Okay, good. Nella, feel free to pick up any points that you want, and indeed all of the speakers, if you've got any points, do just jump in. But Nella, I mean, what do you see as driving this? I mean, I think there's kind of broad agreement that has been accelerated a bit by the pandemic, but are you seeing it driven more by regulation, more by demand from capital? What's your sense of what's driving this trend?
Great. It's, I think, all of that. In the past, investors have been looking for performance, obviously, and it's still the case. But today, what we can see is that they're looking for a performance with purpose and definitely with impact. It's a differentiating factor. And it's a kind of triptych: regulation, investor demand, and obviously the convictions of the market. And that's what's our role as an investment manager, to push and combine all these elements together to develop much more ESG-driven products, impact investing funds, and we will be challenged on our ability to deliver still the performance. This is what we are paid for, and deliver what is the impact. We are definitely delivering with that.
And one of the things that's been talked about, you know, in terms of ESG over the past while, is that actually this is just more marketing speak. We're not actually really doing anything, that this is about ticking boxes, not about the industry changing. Michel, do you think that this is now a sign that the industry is changing, this sort of focus not just on ESG, but also impact as well?
Yeah, I believe, Richard, that the industry is really changing. What we see is that investors in our fund, for example, really focus on the combination of financial return and social impact return. And I believe, especially with real assets, that's also really possible to achieve that. One of the big changes the last years that it's also possible to measure the social impact. I think that's really driving now the flow of capital to impact investments.
So from your point of view, the measurement is a really key element of that.
Yeah, I think that's a key element, and it's also, to be honest, a challenge. It's possible to establish a framework for which groups you want to achieve the social impact, and it's also possible to define the indicators which you measure on, but really measuring, that's still challenging. As for example, with affordable housing, it's possible, but if you go to indicators which we do like satisfaction, it's more complex, and also complex to compare it with your competitors.
Okay, and Martin, do you see this? I mean, I suppose, how do you see this measurement of ESG, particularly in that sense? How much of a challenge is I suppose measurement, and is this a kind of evolving situation where it's gradually improving over time? What's the position there?
Yeah, absolutely. I think well, to kind of, if we look back probably about 5 to 7 to 10 years, measuring the E was hard. and now measuring the E is easy. Well, it's much easier. It's not necessarily easy. You still have a number of tenants who are saying, I just signed a 20-year full repairing and insuring, please. Why would I give you that information? Just kind of get out of my sight, you know, like almost wanting that absentee landlord. However, we are seeing that a lot of investment managers, and I'm sure Nell and Abby and Michel would actually be able to say that, to confirm that, is like, we actually want to be measuring the E. And I think the next stage is actually measuring the S. And to quote one of my professors from university, whatever gets measured gets managed. In order for us to manage it, we first need to start measuring. And I think there is a lot of work, there's a lot of very interesting insights that are being derived from measuring the E. The fact that we know nowadays that 40% of carbon emissions come from the built environment. It's massive. If we're looking to achieve net zero carbon, we have to start with the built environment. And equally, if we want to make a positive societal contribution, we have to start measuring the S and then managing these outcomes.
And I wanted to pick up with you, Abby, just that point of intentionality. I suppose, how key is that? Is that the real differentiator between what might be an ESG strategy and what is an impact strategy?
Yeah, I think it is, and I think, you know, you asked about how has the industry changed, and how is this more than just marketing, and I do think that intentionality piece is really important, because it stops that E or S piece from just being incidental and just being a positive impact that happens to happen on the side, and we'll maximize it a bit. If you've got intentionality, then actually the whole strategy has to be built around delivering that, and every investment decision that you make has to return to that environmental or social objective. So I think the intentionality piece gives a completely different perspective than just incorporating ESG in. And I think incorporating ESG across mainstream investment is great and positive, and the industry has come a long way doing that. But for those investors that do want to have that extra purpose and go that extra step, then that's the key with impact investing, that it can do, the intentionality piece means that it's a transformative investment, and that every decision is really rooted in delivering that positive impact as well as the return.
And Nella, just coming to you, because obviously BNP Paribas real estate investment management side, I should get it correct, that you've been launching a specific impact fund. So I mean, maybe just talk us through the strategy of that, the decision around that,
Sure.
and how that operates and is maybe different to some of the other funds.
Absolutely, and that's why I wanted to jump in following what Abby was just saying about intentionality. So we have launched a few months ago an impact fund, the first, I would say, a property fund with an impact strategy aligned with the Paris Agreement. The objective of this fund, which is a European one, multi-asset class and a core strategy, is to target a reduction of the CO2 emissions of the fund globally by 40% in the next 10 years. So you can tell me that it's just the regulation in some countries, but when you have an investment strategy which is European multi-asset class, it becomes challenging. And that's the target of this impact fund. And where is the intentionality in that? If you want to illustrate what Abby was saying, we have put specific assumptions in the business plan of the fund. We have assumed that for each investment, following some estimation, that with around 200 euros per square meter for office building in Europe, we can reach this target of 40% of reduction on the CO2 emissions. In this fund, we do not plan to have heavy refurbishment. We want to upgrade all the existing stock. And that's what Martin was talking about. This is where the challenge is, upgrading the existing buildings with soft CapEx, OpEx, and a strong stakeholder engagement. So that's the plan. The key challenge will be to track that, to measure it, and to demonstrate, obviously annually, to our investors that we are able to deliver that. And this is, I think, where the problems will come, because it will be difficult to collect data to reach the objectives, and that's why we believe it's a very challenging strategy fund.
Okay, no, that's interesting. And this is to anybody really, but in terms of the in terms of those challenges of reporting, measurement, benchmarks. I mean, I think it was interesting, Martin, that you said there that that's at least there or significantly there in terms of carbon, but not necessarily some of the other sides. How important are benchmarks moving forward for actually pushing this, pushing the impact side further? I mean, Ron, from your point of view at the SHHA, I know that that's an area that you're very keen, that sort of benchmarking side, so that then we can push that forward. So do you see this sort of research element as a critical part?
Well, absolutely, because I think when we have data, we can compare also asset classes, we can compare performances. But I also think we need data to make a crossover towards valuation. And I think valuation is the most critical part in terms of measurement, because I totally agree with Nella, I told before, when we have an existing stock and it's outdated, we could have a valuation before and after. And I think the most important is whether we will invest in existing stock and where we can make an upside on the valuation side. And therefore, in terms of benchmarking, both on the ESG elements, but also on valuation, we need to create this insight, whether it's a viable business case. And indeed, whether it's on social, on senior housing or healthcare, on more housing asset classes, I think in general we need this data for the capital providers. So I think this is quite a crucial element, the valuation side.
And Michel, it was interesting, Abby's slide there about the relative elements of return, both in terms of the impact return and the financial return. When you're looking at that, how do you see that? I mean, do you see it as that there's, you're sacrificing in some way financial return in order to be able to have the social return? Because that's obviously one of the concerns that a lot of people have is, aren't we just simply sacrificing returns here?
Well, I believe that that's an outdated thought. We strongly believe that social return drives financial return. And for example, if you look at our business, we are investing in healthcare properties in the Netherlands. If we are able to achieve a higher social return, for example, higher satisfaction rates with our residents or healthcare workers, we strongly believe that that will increase the occupancy of our properties and therefore drive financial return. So we don't see that as pushing down financial return, not at all.
And Martin, how do you see that?
I completely agree with what Michel is saying. I think that's very much an outdated concept of having to sacrifice returns, and I would argue that over the long period, and there were actually quite a few studies that over the long period, impact style and ESG style strategies actually outperform. So the very core nature of impact strategies that you're targeting a specific problem, which is less transient than a commercial fad or fashion. And I think that intransience of the problem, such as what Nella was describing in their actually fund, reduction of the carbon emission, that's not gonna happen. I mean, even if Nella's fund reaches 10 billion, it's still not gonna be enough to kind of get us to the carbon neutral position that we want. So we are all invested in the success of these impact strategies. And because of the size and the non-transience of the problems that impact strategies address, over the long term, these are very stable, predictable propositions from an investment standpoint.
Okay, good. I wanted to just pick up a little bit on some of the sort of sectors that you know fit naturally with this, and you highlighted them a little bit, Abby, but let's drill down a bit into that. I mean, how much of this is city transformation? How much of this is looking at specific assets like life sciences, like healthcare? What naturally sits into this area? And that's for anybody, really.
Well, I don't mind just taking that one to start with, and I think that's the wonderful thing about this style of investment is that actually I do think it suits real estate so well, because at its heart, real estate exists to provide buildings that are of use to people. So if your buildings are not useful to people, then not only are they not going to deliver a positive social impact, they're also not going to deliver the financial return that's necessary over the long term. There's some really clearly obvious sectors that you would start with, the most obvious for impact investing, such as affordable housing, such as provision of healthcare, education. I think also, as Nella has highlighted, a strategy specifically looking at transforming buildings to be net zero carbon, but actually investing in a responsible way in any real estate strategy that provides a benefit to a community, whether that be social and environmental, can be an impact investment, as long as it's set out with that clear, what is the intention, what is the benefit, positive impact that you're trying to achieve, how is that being delivered and how is it being measured. So that's why real estate and other real assets suit the impact investing style so well, because a building at its heart has to deliver a socially useful purpose, or it's not going to have a future.
And Michel, just talk us through in terms of your sector.
What do you mean, Richard?
I mean, in terms of, how are your investors seeing that? So, how are they seeing this impact element of it in terms of the overall, view on your business, really?
Yeah, what we started out the fund a couple of years ago, and we attracted some investors who were looking for the combination of a financial and a social impact return, and we set up an investment process where both were included, and now each and every asset we are looking at of investing is going through that process. And also in the investment decision process, the intentions of the social impact are included. So we monitor that after acquisition, if they are achieved, and if they're not achieved, how we can simulate those indicators by extra measurements to achieve them afterwards.
Okay, good. And Martin, I just wanted to pick up with you. In terms of the sector side of it, you're focused as well on the residential side there as part of your responsibility at LaSalle. So, Abby already mentioned there the affordable housing side of that. So how does that work with your strategy, and how do you deal with issues like Abby mentioned there, which is about how do you ensure what's going to happen with those assets next and those kinds of things, that they're not sold on to somebody else? How much of that is necessary within this strategy?
Yeah, no, absolutely. I think that's an excellent question. I think the comment that Abby made about impactful exits is a very, very important one. It is in the way that we have defined impact investments within LaSalle is a focus on homes, health, and learning. I was very pleased to see that Abby have actually kind of come up with effectively the same three critical real estate subsectors, because we firmly believe that real estate is the ultimate impact asset class. It's a store of value. It provides safety and shelter for people. It's the place where people effectively thrive and learn. So as such, if you want to invest in from a real asset perspective, real estate is the ultimate impact asset class, by all means. I think we are very much focused on measuring the intentionally going into the investments, and then also measuring the impact of this investment. I think, and then equally that impactful exit is a critical piece for us. We don't want to provide affordable housing. Back to the example that we've been discussing this morning. We don't want to provide affordable housing for a limited number of years. Effectively, get on a planning gain policy that we can flip on in 3 to 5 years. For us, impact investing is a long-term proposition, and it's a long-term income-driven risk-adjusted returns. And in order to achieve that, we need to be mindful of the impactful exit as well.
Which can fit to any asset class, I believe. I mean, as long as you define a specific objective of impact investing, it can fit to office, residential, healthcare, whatever. So we should not limit, I think, the impact investing area. On the opposite, we have to broaden it, absolutely.
Well, that's an interesting point, Nella. And in that sense, how do we broaden it beyond those? I mean, I can see the ones that have a positive impact, but how would you define things? I mean, if you're in logistics or in, I can see it for infrastructure, for example. How do we broaden it? I mean, does it mean that all assets are potentially available to this kind of approach?
I strongly believe that, yes. By asset class, there are specific ESG angles that could be pushed and that could be strengthened. For residential, it can be something. For logistics, anything or something else. So that's why we have to screen and try to fit that to the different investment strategy of our portfolio and propose it to our investors. So yes, I think so.
Yeah, I also believe that. I think that what we are looking at healthcare, but I think you can border that on all sectors, is we're looking at to achieve an impact for residents, for people working in our buildings, and for the neighborhood. So I believe you can also do that for offices, for retail, logistics, any kind of real asset.
Yeah, I really agree with that as well. I mean, I think if you look at, for example, setting aside a proportion of a building for a more affordable rents for tenants who are providing social value, if you look at job creation and particularly good job creation, so those earning a living wage, if both indirectly through tenants but also directly people employed in the building that to clean or security or that kind of thing. For logistics, if you're looking at investing in the infrastructure around green vehicle charging and renewable energy, you can see with each asset class there are some clear areas that you can focus on to have a positive environmental and social impact within that asset class. So I completely agree with Nella that this works across all real estate asset classes. It's just about identifying what are the specific positive impacts you want to have within each of those and how can they be delivered.
So do we see this as a way that in fact real estate can kind of help lead this transformation?
Yeah, maybe Richard, one additional remark also from a research perspective, because I think we see a shift from nice to have to must haves. And I think in general, when you look from an investor perspective, it's also a bit of the ball game of correlation. So which asset class correlates to each other? And I think investors are more and more searching for asset classes with a low correlation on the economic cycles. And therefore, you see a shift towards senior housing, long-term nursing homes, when we speak about healthcare real estate, the educational facilities, so both the core real estate, but also student housing. And I think life sciences also may be driven by the COVID pandemic. So we are searching for resilient asset classes, but also from a investor perspective, where is the correlation? So when we have an investment portfolio, are we future-proof? And I think this is also what drives sometimes the strategy of investors to focus on different asset classes.
No,
I completely agree with that. Sorry, Richard. Like with what Ron was saying, I think if you are a core/core plus investor in any asset class across the real estate, you can set up, as Nella and Abby and help impact specific targets for each subsector. And effectively, my strong view is that if you are a long-term buy and hold investor in real estate, you have to be targeting positive impact, because that's effectively what delivers the resilience of the income and the resilience of the real estate.
Yes, if we go back a few years ago, environmental certification were not mainstream. Today, it's kind of mainstream. So I think impact investing will become mainstream in the future, because it's the only key and only solution to, especially on the E part, environmental part, to achieve the global objective. I remind you that the global objective is to limit the global warming. So it's essential to work on social and governance topics, but we have to limit the global temperature. So we have to work on the existing stock. So all what we call today an impact investing strategy will become obviously a mainstream strategy in a few years, and it has to.
But Nela, maybe also a bit critical remark, because I think in the last 5 years, we see on the environmental side that occupiers are able to pay more rent when we have outperformance on BREEAM, for example. And of course, that's also related to the valuation of real estate. So when you have higher rental levels, or when you have a lower occupancy grade, the valuation of an asset is more higher. But I think the social side is still difficult. That also was one of the remarks of Michel. It's still difficult when you have a social impact. Where is the outcome of your investment? So when we have maybe a better living environment for people with dementia, you should see it on the rental level of your occupancy, or you can see it on the yield side. And I think this is still a critical element, because valuation of the S is still it's not common. So that's also my question to you. What's your perspective on the valuation side? Because I'm not really positive on the S and the valuation.
Yes, no, I tend to agree, but if I can be more critical, I don't believe that the environmental part is correctly and properly assessed in the valuation and all the valuation, for a very simple reason. It's because 90% of the stock is not certified and not really compliant with a high efficient area. So it's not in our interest or in anyone's interest to decrease the value of that. But I agree also that the challenge will be to much more integrate the social party in the valuation. But let's be careful. It's difficult to address all the topics at the same time anyway.
Yeah, if I may add, I think it's actually a very interesting discussion, and I'm really enjoying it. I think the S part is you have to look at it from different perspectives. If I'm a developer, I obviously have very little long-term hold or incentives to create anything. However, if I'm a long-term buy and hold investor representing a pension fund, I have all the incentives to create, as Abby rightfully pointed out, a sustainable, a living environment that's actually opening and welcoming to all. I mean, the King's Cross regeneration in London is a prime example. It's a long-term vision. The South Bank regeneration, or Stratford regeneration, these are long-term visions. So you just need that long-term investor to start driving the change in behavior in the development side, or in the short to medium-term investors. And I think that's what we are seeing, or at least that's what we are seeing at LaSalle, is that it's the long-term asset holders that are saying, hold on, you cannot just assume that this asset is going to flip in 5 years' time, and the fact that you haven't done any of the S, or, well, it started really with the E, as Nella said, and it is feeding through. I've seen situations where effectively assets become completely unsellable within a short period of time because of the E side of things. Completely unsellable. You go from 20 investors to 0 investors, potential buyers?
Yeah, I feel like sort of 5 to 10 years ago, there was a feeling that surely it's obvious that improving the environmental performance of buildings would add to their value, but it was very hard to find any evidence of that. So you had a long period of saying, well, it's obvious that you improve the environmental performance of a building, you reduce the running costs, you make it a better quality building, it should add value, but we were struggling to get there. I don't think we've completely solved that yet. I would agree with Nella, but I think that we are really on the cusp of that now, and it's not a controversial thing to say that buildings that are more energy efficient, that are certified, are going to hold their value better, or that buildings that are really inefficient are at great risk of obsolescence. I think that's a very accepted mainstream view. I think we're in the same place now with the social, where you feel, well, just of course it's obvious that a building that is meeting the social needs of the local community is going to hold its value better, and is going to be is not going to at risk of becoming an elephant and not being losing its purpose. So I think that there's an obvious thing there, but it's really hard. The data doesn't exist. What do you actually monitor? How do you correlate that with value? We're definitely still at the point where we're just starting to gather that information, and hopefully those proof points will start to emerge. But as a long-term investor, I think can make that conviction call and say, well, we believe that by investing responsibly and by focusing on the social value, that will protect the value of our buildings. We don't necessarily need to see all the proof yet. It feels like the right kind of call, and we believe that data will start to emerge in the next few years.
Interesting. I got a question from Martin Zanocchi here. Thanks very much for joining us, Martin. Which is there any issue for the major decision makers, or a question of how to make investments, I suppose with good intentions? So is this something, I guess, that probably more for Abby, Nella, and Martin. Outside of the impact funds or the strategies, are people looking at these now assets? Is it beginning to feed more into asset selection more generally, even if it's not a specific impact fund? In terms of the acquisition process, are people beginning to run that through more widely than just for if it's an impact strategy?
It is. I think it is. I can give the example of what we do at BNP Paribas RIM. All new investments are screened through an ESG assessment, just at least to have a photography of the potential ESG risk of the building. It is a necessity, as a few years ago it was about the pollution or the area of where the building is. So it's becoming mandatory. Plus, we should not forget that some climate risk and physical and more specifically transition risks have to be assessed and identified to make sure that what we are buying today is not going to be obsolete in 5 to 10 years due to some specific climate impact. So it is becoming more and more asked from our investors, and it's our responsibility of investment manager to push and propose that and be more selective at acquisition, definitely.
Okay, good. And Martin, if that didn't answer your question, send it to me again just to let me know. but I hope it did. I wanted to pick up a little bit, just because there's sort of 15 minutes left now. So again, if you've got any questions, now's the time. I just wanted to dig into the part, Abby, where you said about I suppose how it might influence different areas, and particularly the exit strategy, but also the asset management strategy. So do we now have to think far more about, areas like tenant selection, supplier selection? Is this something that we have to live as an investor, and look at all of those areas? Does it matter, for example, what your tenant is doing in your building?
Yeah, I think it does require a much more active asset management role. This type of investment, you do have to be a much more involved landlord and steward of the building. So yes, it certainly for a specific impact strategy, tenant selection is key. And there are certain types of tenants that you'd probably or certainly would screen out, but more positively working with tenants to deliver positive environmental and social impact will be at the heart of a successful impact strategy. So I think it is about, it's not just about what kind of buildings you buy, it's about how you manage those buildings, what you do with those buildings, and continually coming back to that as well, particularly with this long-term perspective about looking at, well, what is the right long-term investment strategy for this asset? How do we adapt it to make sure that it's meeting both from an environmental and social perspective the needs of the area it's in, and how do we engage with both the tenants and the local community to take that on board? So it does require a more active approach than maybe has been standard to date.
And will that mean an adjustment? I mean, Martin, when you're talking to the asset management side, for example, does that mean a real adjustment in their way of thinking?
It does, actually, it does. It means that effectively almost every type of real estate becomes operational real estate. So you have to understand your tenants, you have to understand what drives them, you have to understand how they make decisions. So I think that's for me, that's kind of the real change in terms of the asset management thinking, and it's interesting because in the operational real estate, for example, in residential, that's been the bread and butter of how residential has been operated. But I think some of the other asset classes are kind of very quickly kind of coming to that realization that you can say that, yes, I have a shopping center that's it's generating the 7% yield, and that's fantastic until it's not. And then you kind of have to get into the operational more effectively, like who's going to step into that into the shoes, how do you actually change it, how do you reposition it very, very quickly. So being on the operational side is, for me, it's a really exciting place to be in order to drive change, and both on the environmental, the social, and the governance side.
Okay, good. And I just wanted to pick up in terms of I guess the main strategy is to deliver the social benefits and financial returns. What are you, I suppose, Abby, what are you actively doing in terms of the business there in order to be able to do that? And I suppose, how much preparation is there in the strategy and then the delivery of that strategy?
I think we look at both the environmental and the social. So what we're doing on the environmental side is ensuring that we have a business plan in place for every individual asset to achieve a specified reduction in energy and in carbon emissions, and to achieve net zero carbon by a specified date. So it's about setting up that typically will be 5 to 10 year plan to get the building to that point, and what that looks like in terms of when you can get in, make the necessary upgrades, the ongoing improvements that you can make, and that being at the heart of the plan for that building. On the social side, I think on the environmental, there is almost a sort of a clear pathway of how to do that. Yes, it varies building to building, but there are, the things that you need to do to a building. You have to make it more energy efficient. You have to improve the glazing in some instances, get rid of the gas. You have to put renewable energy on it. There is a route map there. On the social, as we've all been discussing, it varies so significantly from asset to asset. So it's and it depends on the strategy of the fund that it sits within. So there, it's about being clear on, or are we monitoring delivering a certain number of jobs with this asset, or is it a certain amount of space that's provided for affordable uses to socially useful tenants, and how do we how do we define the criteria of what that is? So there's quite a lot of specificity in terms of setting up for each individual asset. How is it socially useful? What does that look like, and how are we monitoring and measuring that? So it's quite an involved process. And we were just talking about this shift in asset management and it being a big change. It really is quite a significant change, because that's not something that I think an asset manager would typically be used to doing. So it is a very different approach to the role, and being able to actually set out like that what social goals you want to achieve with each building and how you're going to monitor and deliver that.
Great, thanks very much. And thank you, Gregor, for your question that's just come in. To all speakers, is there a risk of impact washing? So we've had greenwashing, now impact washing, in the absence of any clear targets on the ambition of intentionality and additionality. So I don't know if anybody wants to pick up that point around impact washing replacing greenwashing.
I can start if you want. We have a very nice regulation that just came out last week, which is called SFDR, coming from the European Commission, which will definitely, I think, avoid more and more the greenwashing and impact investing, making sure that in all financial sectors, all products are kind of set into a specific category with specific requirements. And I strongly believe that it will support the decrease of the greenwashing and hopefully no impact washing.
Okay, great. Does anybody else have a view on that?
Yeah, if I may, just for a second, I was going to say, yes, there is a real risk, but I think that the way that we tackle the risk is the intentionality. So if you try to retrofit an impact strategy into a vehicle or into a strategy that it was not intentionally set from the very beginning to deliver positive impact, then I think you have a higher risk of impact washing. If the vehicle was set and has very clear goals, whatever the goals are, then I think the risk is significantly lower.
Okay, good. Quick question for you, Ron, actually, that's come in from Martin, which is, how do you test the degree of social impact created and how much beneficiaries sustainably benefited the senior housing investment from different asset classes? I read that dreadfully, Martin. I'm terribly sorry about that. So, Ron, I suppose just that's a question again, a bit about that measurement side. I suppose, how did you test that in the social housing side?
Yeah, well, I think it's the $1 million question. So on one hand, I think when we have enough competitors, we see the competitive it will level. So when we, but I think you see it on the deal flow maybe, and therefore also coming back to the valuation, when we see emerging markets with high yields, and when we see entering new competitors, we see a yield compression. So I think going back to regular economic cycles, it always takes time when you have a mature asset class or mature asset market. So therefore, I also believe when investors nowadays are focused on senior living, we see more and more pan-European strategies where they try to invest in mature markets, but also explore new markets like the CEE, the Nordics, or Italy, for example. So that's also, I think, one of the benefits of real estate. There's always an economic market principle where we can fall back on. And that's also, I think, my reaction on the impact washing question. I think when we have enough competitors, clients can choose, and I think when we have some regulations, I think the regulations were positive on the environmental side. So when we have the Paris Agreement, you should focus on. So it's really a kick-out criteria, and I think we also need this on the S side. When we have hard criteria, you're out of business when you're not performing. So that's also why I do believe in, and maybe one additional remark, because I think the real estate business going to a new era in terms of we see more and more purpose-driven professionals. So I think in maybe 5 or 10 years, let's be positive, I think real estate is really driven by purpose-driven professionals, thought leaders, and organizations. So time will take, I think it takes some time, but in the end we will celebrate ESG and impact investing.
Okay, good. And that kind of brings me around to, I just wanted to pick up, I mean, that sounds to me like that's your kind of key trend that everyone should look out for, Ron, in terms of impact investing. So let me just pick up with others as well. Michel, in terms of your sense, what are some of the key trends that you think people should look out for?
Well, if you look at healthcare real estate, one important trend is the aging population, but also a population that is impacted by more diseases and conditions. So I think that's a key trend, and another trend is that a changing demand for real assets from the consumer side point of view. So I think that those are the key trends we see in the market now.
Great, thanks very much. I mean, it's been really interesting to see the sort of ongoing discussion around particularly specialist real estate created for dementia and those kinds of things as well. Yeah. Martin, what's your sense of that? What the kind of key trends?
I think the key trends from our side is that there will probably be a flurry of various different frameworks to measure the S over the next 12 months, and then there'll be a consolidation of these frameworks. I mean, it's the same with what happened with accounting standards. I think the same is going to happen, or the same happened with environmental standards. And now the S, from my perspective, is the next area where there'll be a lot of measurement. It will be slightly sporadic at the very beginning because we're just trying to figure out, first and foremost, as Ron pointed out, what exactly are we measuring? And then once we figure out what we're measuring, there'll be a consolidation of frameworks. So I think there will be, my guess is that in 5 to 10 years time, to use Ron's kind of frame of reference, you'll see a very clear measurement and management of the S, the same way that we now have the E, or we're almost getting there to the E. I'm sure Nella is going to correct me there.
Great. What about you, Nella?
Well, I think we will move gradually, but probably quickly, from integrating ESG just to prime offices to all asset classes, with a big focus on alternatives. And by alternatives, I think about healthcare, residential, logistics, which are becoming more and more alternatives for traditional investors. And our role and challenge will be to keep a high level of integration of ESG in these asset classes, and at the same time pushing new impact investing strategies on E, S, or G, or the three of them.
Great. And last to you, I mean, and actually, Andrew, good to see you. Andrew Peterson's just snuck a question in right before the end, which is, we know what green is, but how do we measure the transition from brown to green in a meaningful way? So I don't know if you want to just pick that up in your kind of trends.
Oh, that's a good question. And actually, one of my key trends was really this concept of the green recovery and building back better. You know, we're at, hopefully the years ahead will be more positive than the last 18 months that we've just had. And you know, economies across the world are going to be focusing on how do we invest positively for the future, how do we bounce back, and I think putting you know, the transition to the low carbon economy at the heart of that is absolutely essential, and therefore transitioning the existing real estate stock from brown to green by improving its energy efficiency and making large scale retrofits to real estate globally is going to be absolutely critical, but also including a focus on socially responsible investment within that as well. So looking at investing in underserved areas, place-based investing in real estate that's actually meeting social needs. So wrapping both the environmental and the social together into this concept of building back better, I think is the trend to hopefully see emerging in the years ahead.
Great, thanks very much. Really interesting panel discussion. Thanks also thank you to all of the speakers, and thank you to you for your comments and your questions. The next session, you can obviously network now. You can have video calls. You can contact everybody who's here. The next session is going to be a sort of one-on-one actually with Abby and Claire Thomas from CMS, looking at driving sustainable returns. And then straight after that, there's a market presentation from Christiana Conrads of PwC, which actually picks up that point that Nella raised there around new regulation. So that's a kind of view on regulation and the potential impact that that's going to have. And then there's another panel, which interestingly that you mentioned that is called ESG and Driving Sustainable Returns, Building Back Better. And that's got a super panel as well. So we've got James from BRE, Assem from Berlin HIP, Sasha from CBRE Global Investors, and Clemens from Redevco. And we'll pick up on a number of the issues that we've raised here as well, because I think that's really important to connect these areas of impact also with ESG. Thanks very much for joining us. Look forward to seeing you in the afternoon sessions. And in the meantime, have a good break. Thanks very much for joining us.
Thank you, Richard.
Thank you. Bye.
Everybody.
Bye.